Hey, good afternoon, everyone. Marty Mazzora here. It's Friday, the 1st of July, 2022, with your economic update and a quick stock market snapshot for you. I'm going to run through this relatively quick and do the usual, talk about our graph, handful of our inputs, and again, run through some charts and do a quick technical analysis of the S&P 500. So we actually ticked up just a titch. We went from 4 and something to 6 and something on our macro index. Still close to recessionary conditions. If you listen to much of the punditry right now, we are there. You know, we contracted in the first quarter of this year. And if you believe the Atlanta Fed GDP nowcast, their reading as of the end of the quarter was a negative 2% on an annualized basis. So the textbook or the technical definition of recession is 2 back-to-back quarters of contraction. The NBER, the National Bureau of Economic Research, is actually who gives you the official word on recession. They have a group of indicators that they track. From what I understand, those indicators line up and signal recession pretty consistently with 2 back-to-back quarters of contracting GDP. Our assessment is that we're not there yet, that we don't have the net risk of recession in the near term, call it foreseeable future, but we're really, really close. That absolutely could have happened this week, like it happened back here in August of 2019 before this recession right here. So, and then when we back test our index over the last couple decades or so, it did turn red ahead of both of the recessions in the early 2000s and then the 08 recession. But right now we don't have that signal. We're going to run through some of the inputs. You'll see why we don't have that signal just yet. In the portfolios, we are allocating more toward defensive positions. We've made, again this morning, our third allocation to treasury bonds, our second allocation to emerging market bonds. We added to our utilities exposure this morning. We took some off in an area or two. So we are allocating more defensively, but we still are positioned to take advantage of what we think are the smart themes longer term. We just, again, believe that the market probably has more to play out to the downside before this particular bear market is over. Good news is it will be over. And as all bear markets and recessions do, it'll end amid some real important opportunities and smart positions to take that would be consistent with our longer term thesis. So without further ado, let's get into the data points, although I do want to start with that Atlanta Fed GDP nowcast. I mentioned that it is pointing to a -2. This is what it looks like right here. Now, I do want to note, though, that GDP did contract in the first quarter this year, and you wouldn't know that from the GDP nowcast, right? It was in the positive, a bit above the zero line at the end of the first quarter. It did dip below during the quarter, but it wasn't there to finish the quarter. There's a lot of folks who've been, wanting to get credit for calling recession who right now are already calling it. Look, we're in recession. The GDP nowcast says it. Okay, and it may very well be true, but it wasn't saying it at the end of the first quarter when we did contract by. Now it's been revised to negative 1.6% annualized in GDP. So, jury's still out. We'll wait and see. There's recessions and then there's recessions and there's different implications for the markets, based on what the Fed is doing. In this case, there's a lot of consternation because the Fed continues to tighten monetary policy in the face of a slowdown. And I've written about that, I think, in yesterday's morning note. I shared with you kind of my musings from our own internal market log on that topic. So lots more to come in the days, weeks, and months ahead on that topic. We'll go ahead and start with the staples sector, staple stocks to discretionary stocks ratio. Staples would be your economically defensive stocks, right? Things you got to spend money on to stay alive. Discretionary sector captures the stocks that you spend your discretionary income on, right? So when the market is treating staples better, and this is a ratio, right, than discretionary, That suggests that more money is flowing to staples, which would be your purple line here, versus discretionary, which would be your orange line here. Therefore, the ratio is going up. And that is a signal of weakness in the economy for obvious reasons. So that would be a negative in our economic index. Personal income, those numbers came out this week. They're actually on a month-over-month basis. They were up by 0.5%. That's what that little label behind there says. On a year-over-year basis, actually up by 5.3%. So personal income of late actually would be positive from an economic signaling perspective. Consumer confidence is an absolute mess. University of Michigan, lowest reading on record. Conference Board, different questions. Conference Board, they ask more questions. They kind of come at things from a variety of angles. Not its lowest, but certainly not positive. Definitely going in the wrong direction. The Langer, more high frequency weekly sentiment index or comfort index. Again, what are we at? 2015 lows. So consumers are not feeling good about their go-forward prospects. Inflation is the thing that they are mentioning the most as being a problem for them. Initial jobless claims, we had to give this a negative read finally in our index. These are still historically low numbers for sure, but folks, it's really about the trend. And as you can see, even coming off of relatively low numbers, once we start moving in an upward direction, that tends to ultimately lead into recession. So this would be a confirmation that recession risk is high, and as some people think maybe we're already there. Continuing claims also ticked up just a little bit this last week. Durable goods orders, on the other hand, actually ticked up to a 12% year-over-year change and a 0.7% month-on-month. So again, durable goods orders certainly right now are not signaling imminent recession. Nor are, in the least, heavy truck sales. Heavy truck sales have actually been a pretty good recession indicator. And as you can see here, folks, that's not going in the direction that would say that recession is imminent. In fact, we're breaking above this downtrend from late 2019. So again, there are conflicting, call it mixed signals out there. Personal consumption expenditures data, that's where we got the personal income data that I just mentioned a minute ago. We also have the deflator, and that is what the Fed supposedly looks at more so than CPI. So the headline number is up 6.3%, very high inflation year over year. The core number, however, which X's out food and energy because they're so volatile, presumably, was off notably to 4.7%. The headline on a month-on-month basis, 0.58. So yeah, inflation's still very high, particularly relative to an economy that looks like it's rolling over a bit. So speaking of inflation, among our market-based inflation indicators, these are actually what we call inflation swaps, 2, 5, and 10-year. Note how they are rolling over, which really denotes the anticipation of significantly lower inflation than what we were discounting back here. Commodities, huge relative to inflation. The Bloomberg Commodity Index really rolling over hard right in here. Again, a very deflationary force. I featured this, I think it was earlier this week in a written blog, and I showed this as support for the notion that inflation is peaking and rolling over. However, I kind of pulled the rug right back from under it, showing you some of the wage data and talked about how, quote, sticky that is and how that could serve to offset, if not more than offset, some of the relief that we're seeing in the commodities space. Jumping over to copper, pretty much where we were last week, is to be very correlated to the economy. As you can see it rolling over here before the recession, the COVID recession, we'll call it. So I think this speaks hugely to the COVID lockdowns in China that they've been enforcing of late, easing up of some lately. China's got very ambitious GDP targets of their own between now and the end of the year. Wouldn't surprise me to ultimately see this as a pretty good buying opportunity. Could go lower. A lot of people are calling for 8,000 support. Could very well. Our long-term thesis is very supportive of having some exposure to copper futures, copper miners, etc. going forward. Right now, again, we were drawing this picture when copper was up in there, so this is no big surprise to us. You're hearing a lot of people say, oh no, this is evidence that the economy is in or is rolling into recession. Well, certainly historically, I understand that completely. I do think there's more to the copper story going forward, though, than just it as an economic indicator. So folks, we'll leave that there in terms of the economic update. Real close to recessionary conditions, not quite there yet by our assessment. Now we'll do our quick technical update. This time I'll start with the long-term charts and move back. This is the moving average convergence divergence signal that every time we had this over the last 30 years, at a minimum, we tested the 50-month moving average. We're 9% above that right here. If we were in recession other than the COVID recession, we crashed right through it and ended up with a 50+% drawdown. And of course, we're talking about recession right here. So we need to be very aware of the potential downside risk. Very different setup with regard to the Fed right here. Back in here, the Fed was beginning to or actively in the process of easing monetary policy. I suspect we will get there. Time will tell. Much more color on that you'll be receiving from us going forward. I'm looking at the weekly chart. I'm going to really zero in on the weekly 3-year chart. We're about 7, call it 8% above our non-recession target, which is right at 3,500. The daily chart actually continues to look constructive. Now, this surprises me, frankly. Overnight futures, the S&P was down like 1.5% at one point. The Dow was down, I don't know, 300 plus points. As I speak to you today, we have quite the turnaround. The S&P is up like 1%. Now, it's not the greatest breadth. Energy stocks are down. Most things international are still down. Emerging markets are down. Metals are down. Commodity space is taking a pretty good hit today. So we're definitely not feeling this wonderful rally in our portfolio. I mean, we're catching it in the U.S. stocks and in the sectors that are up. But when I look across from a breadth standpoint, well, maybe 60% of our positions are up on the day. 40% are still down, and those would be the ones non-U.S. Semiconductors are taking a hit. We're taking a real close look at that. We love the sector long term. Looks like there may be a little bit of a glut in inventory, so we may make some adjustments to that this next week. Ag commodities are down 2%. We do have a hedge on those. It actually is up and mitigating some of that today, but we do like that space a lot long term, but we're hedging a bit of it because it can be exceedingly volatile. So again, I've been telling you that the daily chart is looking constructive, and you can make this a wedge if you want, right? Coming from up here to there. Definitely have these bullish divergences, and you do have the SPY signal. I am still somewhat skeptical about early July, but right now, that group that I shared with you yesterday that said the seasonality is positive right here, they're looking pretty smart, at least for one day. And then lastly, and I'll let you go, the 16-minute chart. Just the last 2 or 3 hours began to look pretty good. So you've got what would be a symmetrical triangle, which would be a consolidation pattern. This little move right here in the MACD would suggest you're going to break out to the upside. Lots of resistance up here if the market really wants to take off that I think we're dealing with. But yeah, like I said, I am pleasantly surprised, although we're still 20 minutes before the close, so we'll see how the market shakes out at the end. I'll leave it right there and wish you all a very happy 4th of July. Don't suspect that I'll be bugging your email inbox this weekend. I'll have a note ready for you come next Tuesday morning. Thanks as always for watching and listening. Again, have a wonderful weekend. Take care. Bye-bye.